You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
No stranger to the Gabelli Auto Symposium. I think one of maybe the only company that's been here for all 49 is Genuine Parts, best known for the Napa brand, located in Atlanta, Georgia. It's the premier North American distributor of consumables for the auto aftermarket. With us today are company CEO Will Stengel and CFO Bert Nappier. But 140 million shares or so, about a 17 billion equity cap, about geez, I can't even read my own writing anymore. 3.5 billion of net debt, about 21 billion total enterprise value. So Eddie's going to lead Q&A, but we thank you all for being here for all 49, and then looking forward to seeing you at 50. Welcome, Will.
Just to clarify, I have not been here for every 49,
No,
but
our
firm has. Thanks for having us.
Thank you for being here. 49, it's impressive. So you recently reported third quarter results and narrowed your outlook for 2025. Can you just quickly touch on the results and your updated outlook?
Yeah, we had a really strong third quarter performance. I think it was best represented by a quarter where, we controlled what we could control and did what we said we were going to do. So we had 5% top line growth. We had very strong gross margin performance, up 60 basis points. We had 10% growth in adjusted EBITDA versus prior year, and we had 5% earnings growth. I think if you actually peel back the underlying facts, we saw really strong sequential trends in our Napa business, both in terms of our company-owned store performance as well as just improvement versus prior quarter. We also had very respectable strength in our motion business, growing 5%. Our motion business is in our industrial side of the house. And in a flat market, 5% is really strong performance. So really good cost control, good discipline. And because of the strong quarter, we were able to update our outlook for the balance of the year, which I'll let Bert talk about.
Yeah, so I think if you guys have followed us all year, you've heard us talk about the fact that our original guide for the year included an expectation for a more significant, more robust upside in the second half, accelerating recovery across the balance of the year. We narrowed our range, and really that's because we saw the opportunity for the upside for the rest of the year had really not materialized in the third quarter, just based on the back of macro and market conditions. But within that, we had a lot of positive trends. And so when we take the upside of the 25 cents away and narrow the range to 750 to 775, we're still going to have a really solid fourth quarter. We raised our revenue outlook for the year just based on current trends, which we see being stable and steady. And it gave us an ability to give it a little bit more positive outlook on the top line. We're going to have continued gross margin expansion in the fourth quarter. That will moderate from where it has been through the course of the year. For most of this year, we've been getting the benefit of some acquisitions from a year ago that have now fully hit their anniversary. So we'll see the gross margin continue to expand, but at a little slower clip. One of the most important things that I think we can point to is we're going to get some leverage with an SG&A here in the fourth quarter. And this is on the back of really the tough, gritty work we've been doing on our restructuring, improving our business, improving our productivity and our operations. And that's going to give us from the Q3 kind of flat year over year to some leverage in the fourth quarter. And we're excited about the work we're doing and the stuff we've done in that space. And then finally, I just rounded out with, we updated our interest expense outlook for the rest of the year, just on the back of trends. And so that created just a little bit more pressure. And the net of that is another good quarter, but a little narrower range for the full year.
You just touched on it briefly there, but you guys are in year two of a restructuring and taking some cost actions. Can you just talk about some of the progress there and why you guys are taking these actions?
Yeah, look, I mean, when we look back 2 years ago, we really saw an outlook in which the market demand, the market environment was probably going to be a little flattish. I think that's what we've experienced. Cost inflation certainly was pressured 2 years ago. And we really stepped back and decided that in the spirit of controlling what we can control, it was time to do a little bit of a restructuring of the business to drive some efficiency and productivity. And that's been across multiple dimensions. That's been consolidating facilities. It's been being smarter about workforce, being disciplined about how we do work, and maybe changing the nature of the work and upskilling folks, and really thinking about every little pocket we can find to invest and put the business on the right platform going forward, knowing that we're going to always have cost pressure. And so we have to continue to find a way to reinvent ourselves and think about the way we'll do work in the future. And the result of that was we had about a 20-cent benefit in the third quarter from the restructuring actions. We'll see 200 million of annualized run rate benefits starting in 2026. And so we really think that the work we're doing has been important to keeping the business where it needs to be, but it's also built new muscles inside of GPC, in which all of our teammates are focused on being disciplined and thinking about how to do things smarter, faster, and better as we go forward. And so not only has it been important to just delivering a better result, it's also been important and still instilling a way of thinking across our business that I think is a healthy behavior as we look ahead.
I might add just a couple thoughts. One would be, this type of operating discipline is really important in this inflationary environment that we live in. The other point that I would say is, as our markets recover, the cost structure improvements that we've made will be super helpful as we think about levering the business as we move forward with volume. Our motion business is a great example. We've been very, very disciplined in a extended low growth environment around cost. And that's a business model where if you put some volume through the top line on both sides of our business, but certainly motion, it creates really nice leverage. So we're looking forward to when our markets cooperate a little bit more with us.
Staying on the cost side, can you just talk trade policies and tariffs and how that's impacting you guys?
Look, I think the tariff situation has finally found a bit of stability in terms of just the day-to-day mechanics. I know there are a lot of things that's still happening in the external tariff environment. And so I would never claim to say that that's stable or has found its footing, particularly with the Supreme Court review coming up. But in terms of how we're operating, I think we did a nice thing at the beginning of the year. We had the resources to do this. We set up a command center. We're looking at the tariff situation globally. We've got a team in Atlanta that focuses on it every single day. And while it remains dynamic, I think what we found is that, and as we said in our earnings call, the benefit to the top line has been low single digit, and the cost impact that we're feeling in cost of goods sold has been low single digit. And that's because I think we've been super disciplined about how we think about passing costs through, making sure we're doing the right thing for our customers and keeping them at the center of this conversation. And the advantage we have in this space is our size and scale. And our size and scale has allowed us to partner with our suppliers to keep the cost side of it manageable and fair. And so I think when we think about, like, are we still competitive? Of course we are. And are we managing this in the right way? I think we are. But the size and scale of our business really gives us an advantage. And I think as we looked at the rest of the year, it's part of why we were able to have some confidence in raising our sales outlook for the year, and that we felt like the tariff situation has found stability in the sense of what's happening in the market day to day. Putting the political and reviews and all of those things to the side, which we would never claim to predict or judge the outcome of. I do think some of that getting settled and sorted out here in the fourth quarter will be helpful for just the overall sentiment as we turn into 2026. I do think the tariff overhang is impacting consumer and customer on some level, and thinking about decisions they're making to spend or invest. And getting some of that, I think, leveled out here in the fourth quarter will help as we turn into 2026.
I might just emphasize the point about scale matters in these types of situations, in these markets, where we can bring to bear not just sophistication, but a level of data and analytics to our customers in particular. And I can think of numerous situations where we're sitting down with customers and being very transparent about, here's your buy with us. These are the potential impacts from tariffs. These are your choices around that assortment, and working very closely with them. So I think having the scale and the resources to be engaged that way with our customers in these markets will pay us back as we move forward.
So the consumer is seeing some pressure on higher interest rates, higher cost of living. Can you just touch on how you guys have been able to keep that steady demand, and whether include with these inflationary prices, if you're seeing any concerns with the elasticity?
Yeah, I think we've been pretty consistent with our themes that, you know, our business, certainly in Napa, you know, if you think about our independent owners, really a proxy for small business. And, you know, they've been adjusting over the last couple of years to the new realities, whether it's interest rates, tariffs, et cetera. And so I would say they're sequentially improved throughout 2025 relative to 2024, largely driven just by the fact that they've come to grips with the new normal. And number one. Number two, the intention in which we're working with our customers to help them be successful. There's no doubt that the average consumer is feeling stretched. The good news about our business is it's non-discretionary. So while there might be deferred maintenance, that maintenance ultimately needs to occur. And so we like the position that we're in. We're focused on making sure our customers are being helped to the extent that they need help. And as the market gets better, we're going to be in a great position.
Yeah. Well, as you know, go down this kind of journey looking at your footprint and talk about the relationship between the your independent stores and company owned, and how do you evaluate what's best for GPC and Napa going forward?
Yeah, I think the brilliance of the Napa operating model, which celebrates 100 years, so it's had some success over a long extended period of time, was that the independent owner model is very effective at covering the small town USA rural markets. And so I think we've been very clear that the independent owner model is a really important part of our history and our future. We have been intentional about getting more targeted in specific markets where we wanted to upgrade or modernize our local store footprint. And that could include either opening new company-owned stores or, in some instances, buying our independent owners in those specific markets. We did 2 large transactions last year with our MPEC and Walker that fit our strategic roadmap. They were great transactions for us, and we've done a really nice job integrating that. We will always have a mix of company-owned stores and independent owners as we move forward. The good news is if you look at the variation of performance, whether you're talking company-owned stores or independent-owned stores, is there's great entitlement on both sides of the business, meaning we've got some really attractive, profitable stores, company-owned and independent owners. And our challenge is how do we replicate and quartile up to get some better performing, and that's the work that we're doing. It comes with inventory, pricing, talent work, supply chain work, all of the areas of investment that we have been putting into the business for both company-owned and independent-owned stores, we think is going to make a difference over the long term.
Quick question over there.
So I just want to follow up on the elasticity question. You know, this has been a topic a lot of people are asking within your sector. So I guess, so as you've raised prices as a result of tariffs, I mean, are you seeing any type of like effects, so to say, on elasticity? Then the second question, are you done? I mean, are the tariffs now reflected in your pricing, or will you have to continue to adjust pricing through the balance of 25 into 26?
Well, I would say let's take the latter question first. I'd say, as we kind of shared in our guide here a couple of weeks ago, I don't think we're in an environment where we're going to see an acceleration from our perspective of raising prices. I think it's all kind of leveled out. We've had several months of experience with supplier requests for price increases. Those are moderating out on both sides of our business, so industrial and automotive. And I think we found that kind of low single-digit level of environment. Same on the pricing side. We think the market accepts the low single-digit, and it's been pretty leveled out as well. So I wouldn't see it going any further. And that sort of then leads into the question about elasticity. We haven't seen an appreciable impact one way or the other from the receptiveness of the market to it. So I wouldn't say that they're pushing back. Nobody loves price increases. And so I think it's a market in which Will just pointed out, they're break fix markets. And we benefit from that. whether it needs to be fixed now or it will ultimately need to be fixed because you've deferred it. And so I think everybody has experienced similar market reactions to the price increases. I mean, the last time, if we just isolate the automotive aftermarket, the last time elasticity was really tested at a very high level was same SKU inflation at the end of 2022, in which the aftermarket was experiencing double-digit levels of price increase, and we didn't see any demand destruction at that point. So I think we're living in the right zone and making sure that, most importantly, we take care of our customers through this cycle.
The only other thing I would add is the importance of assortment strategy and meaning the good, better, best. And so in markets like this, going back to the scale matters, the sophistication of the large distributor partner that's got an assortment at different price points and different value propositions is really important. And there's no better example than the work that we've done in our European business with the Napa brand, which was really the introduction of the proprietary brand. And for our business, it's helpful for our customers. And as a result, that will be a 500 million euro business here by the end of the year from essentially zero 3 or 4 years ago. So the work that we're doing around category management, pricing strategy, data analytics, assortment strategy to give customers choices, even though we operate in a break-fix business, I think is also super helpful.
Yeah, just a couple of quick 101s on accounting.
I'll give it to Bert then.
You have a
Mario.
basket of parts, assume constant volume, constant mix in 25, 26. What do you think the part prices will go up? And are the gross margins being able to maintain given competitive?
Given the competitive
And then
environment.
obviously the next question, and then the one after that.
I'll give them all to Bert.
LIFO accounting in US, come on. How was the drag? How did you handle that one?
Look, so I think back to my comment a minute ago, I think where we found ourselves as we exited the third quarter and entered the fourth quarter from a pricing perspective, and I shared some views on this in the call as well. I think this is where we exit 2025 and enter 2026. So to your example of the basket, I would say that we're not going to see an appreciable increase.
Yeah, but you got a number, like 1%, 2%?
No, I'm not going to get out in front of my
okay,
skis
then,
on 2026.
Now let's go to the strategic question.
The strategic question on
no,
how
the strategic question is Moses. You have a shareholder that wants you to play Moses. And can you bring us up to date on the notion of separating motion? Not Moses, motion.
motion. Yes,
I had the wrong word.
We do have a new shareholder, and I would describe our relationship as very constructive. You know, as you mentioned to me in the hallway, you know, every good business is always analyzing itself, and so that statement holds for us. We have no update for everybody today on our thoughts there, but we will continue to do that work and look forward to giving everybody an update in 2026.
Just staying with motion now that we're talking about the other part of the C, or maybe the C doesn't part. Maybe talk about some of the trends that you're seeing across some of the verticals there, and maybe some of the challenges or opportunities that are ahead to both drive top and bottom line on the industrial side of the business.
Yeah, so for folks that aren't as familiar with our motion business, so about a $8 or $9 billion business, it's about 50% of Genuine Parts Company's profit, and the customer in this business is the maintenance / engineer / procurement that we're break fixing work on the automotive side of the business. We're doing that same work inside of a factory. So when line one goes down, motion gets called to be helpful to solve the problem. So it's the same operating model in terms of inventory availability, making sure that you understand your customers, and then timely delivery to get that factory back up and running. About 80% of that business is what I just described, what we call MRO break fix. And about 20% of that business is more capital project-like, meaning the factory is trying to figure out how to enhance or reconfigure a line. And so they're going to take the line down and then reimagine it. And we work with them from a capital standpoint. On the capital side of the business, as you would suspect, that business has been sluggish and choppy over the last couple of years, as folks have navigated a PMI that's been under 50 for the better part of 3 years. On the MRO side of the business, I would say that is a part of our motion business where we've really earned an outsized portion of the market. Our last quarter was a perfect example where we're growing in excess of the market, which is the proxy that we talk a lot about internally. So 14 different end markets. If you think about the exposure that we have in motion, meaning building products, distribution centers, et cetera, each vertical has its own story associated with where we are in the economic cycle, which is the beauty of the diversification of the business. But as I said in my opening comments, we posted a 5% top line in that business. It's got some same SKU inflation, very strong gross margin performance over an extended period of time, and really good operating discipline. So when the market recovers, there'll be very bright days ahead for the motion business.
And just with motion and maybe tying in Napa, sourcing relative to supply chains, relative to tariffs, how has that changed over the course of the last 24 months or so? And what's the outlook for, first of all, your ability to pass on any incremental costs at motion relative to your core automotive operations?
Yeah, I would say, I would put sourcing into the topic that I described with assortment planning. So we call it category management, which is the combination of your sourcing, strategic sourcing work, as well as your pricing strategies. And that has been a very intentional focus for our business over the last handful of years. And so we're really optimistic that the work that we're doing that's required in a market like this, where you've got strategic partnerships with your strategic suppliers and having a very good commercial discussion about how we can compete effectively in the market. And it ties back to the point I keep making, which is scale matters. Most of our suppliers, motion and or global automotive, is a very significant large customer. And so we're able to have those types of strategic discussions as the markets evolve.
Talk about right to repair and what that means for Napa.
I think it's a really important topic. I'm a board member on the CARE board. So I'm on a monthly call on this topic. I was just in DC last month. So it's a critically important area of focus for the industry. I'm cautiously optimistic. It feels like we, take a couple steps forward. I think in all things politics, you take 2 steps forward, 1 step back. But it's a fight that we've got to win. And I think we've got the right industry strength behind it. And it's certainly got the focus of the industry. So it's something that we got to keep in front of us.
If we stick to the bodies of water now, if we hop over the pond to Europe, you mentioned it as, sort of a watch point on your last call. Maybe just walk us through a little bit more color there, if you can, by market or price and volume, just so we can kind of understand what's going on there.
Yeah, I would say, as you would suspect, the European market is choppy. Our exposure at Genuine Parts Company is predominantly in Germany, the UK, and France. We've got a business in Spain, Benelux area, but the majority of our exposure is in the big 3. The political instability is a consideration, social reform impact on local inflation, local wages. So it's not a new dynamic that we're operating in, but I would describe it as choppy. The good news is we're number 1 or number 2 in each of the markets in which we operate. We have those scale advantages. This Napa brand in Europe is a very significant differentiator, where we can come to the help and defense of a customer who's looking for an alternative to tier 1. So large markets, attractive. We've got a very effective M&A bolt-on strategy over there, small deals that are highly accretive that allow us to dense in local markets. So we've got the right long-term strategy. We made very significant investments in our supply chain and technology over there that I would argue not many in the market can replicate. So feel good about what we're doing, but we're just going to weather the storm a little bit with good hard execution.
Is the storm creating opportunities for consolidation? I know you mentioned bolt-ons, but is this sort of an opportunity to do something bigger?
I don't know about something bigger, but we've been very consistent with our bolt-on M&A strategy over there through the cycle, for exactly the reason you alluded to, which it does create opportunities for some of the smaller players who realize that perhaps they can't compete effectively in a choppy market. And so we've had a lot of success talking to those types of targets.
Hey guys, it's Michael Lasser. Hey Will. Hey Bert.
Michael. Hey,
How
Michael.
would you characterize the need for investment in both segments of your business, both on the motion side, which does seem to be gaining share, as well as the auto side, which seems to be moving with the market? And how do you see that unfolding over the next couple of years? Thank you.
Well, I don't know that I would make it so specific to the segments. I would maybe raise it up just a little bit. I think the biggest opportunities that we have to invest in both sides and in both segments are around supply chain and IT. And we've talked about this before. We talked about this at our Investor Day in 2022, in which we looked back, and when you're in a supply chain distribution business, that's the way you differentiate. And over a long period of time, the decade leading into that Investor Day, we'd seen the business invest somewhere around 1% of revenue in CapEx. And as we talked about, we've raised that to 2%, and we've lived in that zip code for the last few years. And that's the right level of investment to modernize. And we think that the modernization of our supply chain on both sides has been important to keep us on our front foot and stay competitive. And we've done that at both Motion and across the global automotive business. A lot of this has to do with DCs and modernizing DCs. And we've talked about the ones we've done internationally, whether it's UK or France. You think about a new DC in Auckland. Those DCs are leaning into the best of everything. And it's the automation, it's the ability to consolidate older DCs, get some efficiency around headcount, working capital. And so there's a lot of goodness that comes from that. And we're starting to turn our attention back to the US NAPA business with some investments across that DC landscape as well. So I think, how do we see it rolling forward on the supply chain side is that we're going to continue to lean into making sure that our supply chain allows us to have the right part at the right time, at the right place for our customer, and re-architecting how that looks. On the IT side, I think it's a host of investments that are going to really push the business forward. And again, this is applicable to both sides of the house. You can start with a Poland tech center that we stood up 3 years ago. And that's an operation that builds technology for the entirety of GPC. It's a differentiated model, and it's build one for the use of all. And we're starting to lean into common technology stack in a DC, regardless of whether it's an automotive or an industrial DC. We're also looking at store technology and modernizing store technology across the NAPA business. It's payment technology and making sure that we're easy to do business with from a payment perspective. And then most importantly, I think the investments we've made in search and catalog are also really important to being successful. You know, a mechanic that looks up a part wants to find it immediately and know that it's the right fitment and that we have the right assortment and we could get it to them quickly. And I think the investments that we've made in that space are also important to being successful. So I see both of those prisms as being a place where we continue to lean into. And we talked about this a little bit yesterday with a smaller group, that 2% of revenue is going to be a good proxy for how to think about where we'll invest as we look ahead. And we certainly have a lot of great opportunities. We're certainly not constrained in any way by where we need to invest or what we can invest in.
Well, Will and Bert, I'm very excited for what you've spoken about today, some of the opportunities ahead, and I certainly wish you well on behalf of the Gabelli organization. Thank you again for being here for the 49th year, and I look forward to seeing you.
We hope we're invited back. Thank you very much.
Thanks,
It's good
guys.
to be with
Appreciate
you.
it.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com.